Welcome back to BullionIQ, everyone. If you are new here, this channel is all about finance and cryptocurrency, explained in a clear, simple, and realistic way. No fake hype, no confusing language, and no emotional trading advice. We focus on data, market structure, and real-world events that actually move prices. Today's video may turn out to be one of the most important discussions we do in 2025 because what is happening right now is much bigger than just XRP. It involves global markets, central banks, and a shift that many people are not prepared for. Today we are talking about XRP versus the Bank of Japan. The Bank of Japan has triggered major market moves multiple times in recent history, and every single time they raised interest rates and started unwinding their carry trade, global risk assets reacted sharply. Bitcoin dropped hard, altcoins dropped even harder, and XRP was no exception. What makes this moment different is where we are in the cycle and how positioned the market already is. So I want you to stick with me through this entire breakdown because this is not about panic and it is not about hype. It is about being prepared. If you support what we do here at BullionIQ, take a second to like the video and share it. That helps this kind of educational content reach people who actually need it, especially during volatile markets. Now let's set the stage. We are currently watching a global margin unwind in real time. For years, Japan kept interest rates extremely low, even negative at times. This allowed traders and institutions to borrow cheap yen and invest that money into higher-yielding assets around the world. And that trade is called the carry trade. When Japan raises rates, that trade starts to unwind, and when it unwinds, liquidity gets pulled out of global markets fast. This is not theory. We have already seen this happen multiple times, and every time it happened, crypto felt the impact. So the real question is not whether markets will react, but how much and how prepared you are when they do. Now I want to address something important because there are a lot of loud voices in this market. Recently, veteran trader Peter Brandt made comments calling XRP supporters uneducated. He has been trading since the 1970s, and yes, experience matters. But experience alone does not guarantee performance, especially when markets evolve. The truth is, many traditional traders struggle to understand new financial infrastructure because they are trained on old systems. What is interesting is that even while criticizing XRP supporters, the same traders openly admit massive upside in commodities like silver. They can recognize structural shifts there, but struggle to apply the same thinking to digital assets. This is not about disrespect. It is about recognizing that markets change, and the winners are the ones who adapt. Here is the reality. You do not need to defend XRP with emotions or arguments. You let the data speak, and the data shows something very clear. Institutional demand for XRP is growing, not shrinking. That alone should make people pause and rethink the narrative. If XRP investors are supposedly uneducated, then how do you explain the rapid growth in XRP ETF assets under management? Institutions do not deploy capital blindly. They do not buy assets they do not understand. And they certainly do not commit hundreds of millions of dollars without deep analysis. This is where things start to get interesting. XRP ETFs have already surpassed some major competitors in total assets. Hundreds of millions of XRP are now locked away in ETF vaults. That supply is no longer freely available on the open market. And this is happening quietly, while retail investors are doing the opposite. In the same month that ETFs were absorbing XRP, retail investors were selling XRP on centralized exchanges. Almost dollar for dollar, XRP left retail hands and moved into institutional custody. This is not opinion, this is data, and this is exactly how wealth transfers happen in markets. While many people are distracted by short-term price moves, institutions are positioning for long-term infrastructure plays. This is not unique to XRP. We are seeing it across tokenization, settlement layers, and liquidity-focused blockchains. But XRP stands out because it was designed for liquidity first. Now zoom out even further. Tokenization is still below 1% of total global financial markets. Stocks, bonds, commodities, private credit, private equity, almost none of it is tokenized yet. Even regulators are openly saying that everything will eventually be tokenized. That means we are not late. We are early, extremely early. And yet, during this early phase, many people are giving up because of volatility. That is normal. Markets are designed to shake out weak hands. Volatility is not punishment. It is opportunity if you understand what you are holding. This brings us back to the Bank of Japan. Every time Japan raised rates recently, crypto experienced sharp drawdowns. But every single time, markets eventually recovered and moved higher. These drops were not the end. They were resets. And for prepared investors, they were buying opportunities. I am not here to tell you that prices will only go up. That is not honest. I am here to tell you what the data says. And right now, the data says volatility is coming. Whether you see that as a threat or an opportunity depends on your mindset and preparation. We need to look at history because markets always leave clues. The Bank of Japan has raised rates and adjusted policy several times over the past years, and every single time, global markets reacted in a very similar pattern. Stocks dipped, bonds shifted, and crypto felt sudden pressure. XRP, like most liquid assets, moved with that wave, not because something was wrong with XRP itself, but because liquidity was being pulled out of the system. When Japan keeps rates low, money flows easily around the world. Risk assets benefit because borrowing is cheap. But when rates rise, even slightly, the cost of borrowing increases and traders rush to close positions. That creates selling pressure everywhere at the same time. This is why crypto crashes often feel sudden and emotional. It is not about one coin failing, it is about money leaving the market. Now let's talk specifically about XRP during those moments. In previous rate hikes, XRP saw fast drops, sometimes sharper than Bitcoin. That scared a lot of retail investors. Many people assumed something was fundamentally wrong. But if you zoom out and remove emotion, you see something very different. XRP did not lose relevance. It did not lose partnerships. Development did not stop. What changed was short-term liquidity. After each of those drops, XRP stabilized. Then, once markets adjusted to the new rate environment, XRP began moving again. Not always immediately, but consistently. This pattern is important because it shows resilience. Assets that die do not recover. Assets with real utility usually do. Another key point many people miss is timing. Retail investors usually react late. They sell after the drop starts. Institutions, on the other hand, plan months ahead. They already expect volatility. They prepare cash. They wait for moments of fear. This is why ETF inflows often increase during market stress, not during euphoria. During the last few Japan-related market shocks, something interesting happened with XRP. On-chain data showed large transfers off exchanges and into cold storage. That means someone was accumulating while others were panicking. This behavior is not emotional, it is strategic. Now let's talk about supply, because supply is the silent driver of price. XRP has a fixed total supply. It is not infinite, and every XRP that moves into long-term custody is one less XRP available for trading. ETFs, institutional custody platforms, and long-term holders all reduce liquid supply. At the same time, retail selling increases liquid supply temporarily. But here is the catch. Retail supply is limited. Once those sellers are done, selling pressure dries up. If demand remains, price finds a new level. This is basic market structure, but most people ignore it during fear. Another factor is regulation clarity. Over the past year, regulatory pressure has slowly shifted from enforcement to framework. This matters a lot for institutions. They do not enter markets without legal clarity. As that clarity improves, participation increases. XRP has benefited from this more than many other assets. Now combine all of this. You have a macro liquidity event from Japan, short-term volatility, retail fear, institutional accumulation, shrinking liquid supply, and improving regulation. This is not a bearish setup long-term. It is a transitional phase. People often ask, why doesn't price reflect this yet? The answer is simple. Markets move when catalysts align. Fundamentals can improve quietly for months before price reacts. Price is usually the last thing to change. This is where patience becomes a weapon. If you understand the structure, you stop reacting to every red candle. You start thinking in phases. Accumulation, volatility, expansion. We are somewhere between accumulation and volatility right now. Another important thing to understand is correlation. XRP does not trade in isolation. During global stress, correlations go to 1. Everything sells off together. Later, correlations break. Assets with stronger fundamentals recover faster. That is when differentiation happens. We are also seeing increasing discussion around tokenized assets, cross-border settlements, and real-time payments at institutional levels. These are not retail trends. These are structural shifts. XRP sits directly in that conversation. So when you see volatility tied to Japan or any central bank, do not immediately think disaster. Think repositioning. Think liquidity cycles. Ask who is selling and who is buying. That question alone changes everything. Now that we understand the historical context of the Bank of Japan rate hikes and XRP's behavior during those periods, let's dive into the institutional side of the market, because this is where things get really interesting. Institutional flows often drive the most significant moves, even if retail traders are panicking or staying on the sidelines. Over the past year, we've seen a massive shift in how XRP is being accumulated by professional investors, ETFs, and financial institutions. First, let's talk about XRP ETFs. These aren't just hype vehicles. They represent hundreds of millions of dollars of real buying pressure that is systematically removing XRP from circulation. For example, Canary Capital, Franklin Templeton, Grayscale, Bitwise, and other major institutions have parked hundreds of millions of XRP in ETF vaults. When XRP enters these ETFs, it is essentially taken off the open market, which reduces available supply and increases scarcity. Scarcity is one of the most fundamental drivers of price in any market, and XRP is starting to feel that in real time. In November alone, we saw an interesting dynamic. Retail traders sold roughly $808 million of XRP from centralized exchanges, while institutional ETFs absorbed $803 million over the second half of the month. That is almost a one-to-one transfer of XRP from retail to institutional hands. This is exactly what I mean when I say the greatest transfer of wealth in history is happening in crypto. Retail investors, often emotionally driven, are capitulating, while smart money is methodically positioning for long-term gains. Now let's layer in tokenization trends. According to recent data, tokenized financial markets are still less than 1% of their total potential size. Stocks, bonds, commodities, and private credit markets are barely tokenized. That means the majority of the addressable market has yet to be digitized. XRP, with its liquidity-first ledger, is perfectly positioned to capture a significant slice of this enormous market once tokenization accelerates. This is not speculative hype. It's grounded in clear infrastructure and demand trends. Then we have on-chain data and market flow insights. The ETF inflows are just one side of the story. Off-exchange accumulation, meaning XRP being moved from exchanges into custody or institutional wallets, is quietly removing liquidity from circulation. Every XRP moved off an exchange is one less available to sell, creating pressure that eventually translates into price appreciation. If retail investors do not recognize this, they will continue to miss the opportunity as institutions quietly consolidate. Let's also not forget regulatory clarity. Over the past year, XRP has gained recognition as a commodity rather than a security. This distinction is huge because institutions need a clear legal framework to deploy capital at scale. With legal uncertainty reduced, institutional adoption accelerates. The combined effect of regulatory clarity, ETF inflows, and off-exchange accumulation is a market structure setup that can support massive upward moves, even during periods of short-term volatility caused by macro events like Japan's rate decisions. Now, let's touch on market psychology and timing. Retail investors often react emotionally to sudden drops, selling at the worst times, while institutions buy quietly. This behavior exaggerates short-term swings, but does not impact the long-term trajectory. For example, previous Bank of Japan rate hikes caused immediate XRP drops of 15 to 45%, but each time, XRP rebounded strongly within weeks or months. This pattern suggests that short-term traders can profit from volatility, but patient long-term holders see consistent gains. Another critical factor is correlation across markets. During global liquidity stress, XRP often moves in tandem with Bitcoin and other risk assets. This can be scary for retail traders who only focus on one asset. However, once markets stabilize, XRP's unique use cases and institutional positioning cause it to decouple and lead upward independently. Understanding this behavior is essential for planning trades or accumulation strategies. Finally, consider the bigger picture. XRP is not just a crypto asset, it is a foundational piece of emerging digital financial infrastructure. Its ledger focuses on liquidity, cross-border settlements, and institutional-grade solutions. When central banks, large banks, and asset managers begin fully adopting tokenized solutions, XRP will play a central role. The current volatility, driven by macro events, is simply part of the journey toward that larger adoption. In summary, the combination of historical patterns, ETF flows, institutional accumulation, off-exchange supply reduction, tokenization trends, and regulatory clarity all point toward a structurally bullish setup for XRP. Even if short-term volatility appears intimidating, the key is understanding the drivers behind the price moves and positioning accordingly, rather than reacting emotionally to each red candle. Let's go deeper into historical XRP price reactions during Bank of Japan rate hikes. This is where patterns become crystal clear and actionable insights emerge. Understanding history helps you anticipate moves, set proper orders, and manage risk efficiently. The first event we need to look at is March 19, 2024. The Bank of Japan raised rates from 0.1% to 0.1%, a 20 basis point hike. XRP reacted immediately with a 15% drop. Panic set in among retail traders. Many sold at the lows, fearing a long-term crash. But here's the key. This initial drop was just the start of a short-term correction. Over the following month, XRP bounced back by 31%, giving short-term traders an opportunity to profit if they stayed patient and avoided emotional decisions. The broader lesson here is that short-term pain can be a long-term gain, especially when fundamentals are solid. Next, look at July 31st, 2024, when Japan raised rates by 25 basis points. XRP dumped 35% over 5 days, a brutal move that spooked many. However, by mid-September, XRP had bounced back 53%. Again, this shows the resilience of the market and how selling pressure from macro events is temporary if the asset has strong institutional backing and real-world utility. This is exactly why understanding macro catalysts is essential. It allows you to differentiate between noise and structural opportunities. Then we come to January 24, 2025, when Japan raised rates by 50 basis points. XRP initially dropped 17% in 4 days, but the correction extended over 9 days, totaling a 45% pullback. Why was this drop so dramatic? XRP had already pumped 500% in just 2 months, from $0.50 in November 2024 to $3.40 in January. Overbought conditions amplified the market reaction. The takeaway here is that market context matters. Rate hikes alone do not create crashes, but combined with overextended positions, they can trigger sharp corrections. Currently, as of December 2025, XRP has a strong base around $2. Unlike previous years, there's more structure in the market. Passive buyers and long-term holders are supporting this level, reducing the likelihood of extreme short-term drops. If the expected 25 basis point hike occurs, we could see a minor pullback, perhaps 10 to 20%, which would bring XRP down to $1.77, $180 if we follow historical patterns. Even in that scenario, it would represent an excellent accumulation opportunity for long-term investors. Let's talk about timing and strategy. The Bank of Japan's interest rate decision is scheduled for 11:45 a.m. to 1 p.m. JST, which is 9:45 p.m. to 11 p.m. Eastern the previous day. Traders should plan ahead, set limit orders, and prepare to let the market fill them. Trying to chase the bottom in real time can be stressful and costly. Patience and preparation are more profitable than reacting impulsively. We also need to consider market psychology. Many retail traders fear volatility, selling during corrections, and missing the rebound. Institutions, by contrast, anticipate these moves. They accumulate XRP quietly during dips, taking advantage of lower prices. This creates a transfer of wealth from reactive retail to strategic institutional players, a pattern we've seen repeatedly. Another point to highlight is liquidity and ETF inflows. With hundreds of millions of XRP already parked in ETFs and institutional custody, supply on exchanges is shrinking. When macro events cause small pullbacks, there is limited XRP available for sale. This dynamic creates a rapid price recovery, often stronger than the initial drop. Understanding this interplay between supply, demand, and liquidity is critical for planning accumulation and risk management. Finally, consider the broader adoption trend. XRP is not just reacting to rate hikes, it is part of a larger financial transformation. Institutions are preparing for tokenized assets, cross-border settlement, and real-time liquidity infrastructure. Every time XRP experiences a short-term pullback, it is essentially a discounted entry point into a long-term growth story. This is why these Japan rate hikes, while dramatic, should not be feared but strategically leveraged. Institutional flows and macro catalysts, it's time to focus on strategy and actionable steps for XRP going into the end of 2025 and beyond. This is where knowledge turns into opportunity, and preparation becomes the difference between gains and missed chances. First, let's talk about positioning for upcoming volatility. As we discussed, the Bank of Japan's rate decision can create short-term dips of 10 to 20%. Given XRP's current base around $2, a 10% drop would bring it to $1.80. And a 20% drop could take it to $1.60. These are historically normal reactions. The key is to set limit orders and plan ahead rather than reacting in the moment. You want to buy during dips, not chase highs after rallies. Next, consider institutional signals. XRP ETFs and custody programs are absorbing huge amounts of XRP. Canary Capital, Franklin Templeton, Grayscale, Bitwise, and other institutional players are quietly consolidating supply. Once XRP is locked into these programs, it is effectively removed from circulation, creating scarcity that supports upward price movement. When you combine this with a limited supply on exchanges, even minor buying pressure can trigger rapid rebounds, as we've seen historically after Bank of Japan hikes. Another key factor is tokenization trends. We are still below 1% tokenization of major financial markets like stocks, bonds, and commodities. XRP's ledger is designed for liquidity, scalability, and cross-border settlement, positioning it perfectly to capture a significant slice of this growing market. This is not hype, it's infrastructure-led adoption. The long-term story is that XRP is a foundational piece of digital finance, And every short-term dip is a chance to accumulate before broader adoption accelerates. We also need to address market psychology. Retail investors often panic during corrections, selling at lows, while institutions quietly buy. History shows this is exactly what happens around macro events like the Bank of Japan rate hikes. By staying calm, understanding the data, and sticking to a plan, you avoid emotional mistakes and can take advantage of these wealth transfer events. Let's bring in historical data for context. Over the last 3 Bank of Japan rate hikes, XRP dropped 15.45% temporarily but bounced back quickly, sometimes exceeding previous highs. In March 2024, XRP dropped 15% and rebounded 31% within a month. In July 2024, a 35% drop led to a 53% recovery by mid-September. And in January 2025, a 45% correction followed a 500% rally, yet XRP continued its long-term trajectory upward. These patterns show that short-term volatility is not a threat to long-term growth. Now let's discuss practical trading steps. For short-term traders, look for dips created by macro events to scalp gains. For long-term investors, use these dips to accumulate more XRP at favorable prices. Setting limit orders at support levels based on historical reaction points like 180 or 160 allows you to systematically increase exposure without panic buying. Passive accumulation over time is often the most effective strategy for long-term gains. Another critical point is macro alignment. Global liquidity trends, Federal Reserve policies, U.S. deficit spending, AI infrastructure growth, and corporate buybacks all contribute to positive tailwinds for XRP. These macro factors, combined with XRP's structural advantages, create a setup for potential multi-digit price targets in the medium to long term. The combination of regulatory clarity, institutional adoption, and historical patterns makes this one of the most favorable periods to enter or expand positions in XRP. Finally, let's consider long-term potential. If XRP captures a meaningful portion of tokenized financial markets, its value could far exceed current levels. Even modest market share in tokenization and cross-border settlement could justify 3-digit valuations. Layer in ETF adoption, treasury-backed allocations, and global liquidity infrastructure, and the upside is substantial. But the key takeaway is that discipline, preparation, and understanding the drivers are what separate successful investors from those who panic during volatility. In conclusion, we are in a unique position. XRP's historical behavior around macro events, combined with institutional demand, shrinking supply, and tokenization trends, creates both short-term trading opportunities and long-term accumulation potential. Whether you are a trader looking to capitalize on dips or an investor building a strategic position, understanding these dynamics allows you to act confidently. The end of 2025 is shaping up to be a critical period for XRP, and those who prepare now will be in the strongest position to benefit.